Tired of the same old housing market updates? Looking for real insights that could save you from financial disaster? Well, buckle up because we're about to uncover the shocking truth that the experts don't want you to know. In this eye-opening video, we delve deep into the past to reveal how the 2023 housing crash is not just a possibility, but an inevitability. Don't be caught off guard when the storm hits. Join us on this captivating journey and empower yourself with the knowledge that could transform your financial destiny. The future depends on it. Before we move on, it's important to address the current state of the housing market. Despite murmurs of an impending crash, the evidence suggests otherwise. While there are indicators pointing to a potential housing meltdown, the current price statistics show no significant changes. However, here's where most people are mistaken. Let's reflect on the astonishing events that unfolded just a few years ago, reshaping the economy and the real estate landscape. Almost 3 years ago, the world was struck by a monumental event that impacted various sectors, including real estate. From March 2020 to June 2022, the price of a median home skyrocketed by 43%, according to the CaseShiller Index. For those of you who don't know, the CaseShiller Index is a widely respected and influential measure of U.S. housing market performance. It tracks the changes in the prices of homes across various metropolitan areas. This remarkable growth surpassed all expectations, bringing immense joy to investors who capitalized on this period of extraordinary expansion. Homeowners also had reason to celebrate as they witnessed their equity reaching record highs. However, for prospective buyers, the situation was far from delightful. Month after month, they experienced the mounting pressure of escalating prices, making it increasingly challenging to enter the market. However, after 27 consecutive months of near exponential growth, the housing market took a pause in June 2022. The CaseShiller Index, as mentioned earlier, reached its peak after a remarkable 43% increase since March 2020. Finally, the narrative was beginning to shift. Over the past summer, prices experienced a decline for 5 consecutive months, falling by 3.6% from the peak. Now that you have an idea of the current state of the market, you might be wondering, how is this evidence of another housing depression? Well, this is because the current market bears a striking resemblance to the housing depression of 2008. The evidence before us paints a bleak picture. Prices have experienced a decline for 5 consecutive months, a rare occurrence in the history of the CaseShiller Index. Since its earliest recordings in 1986, the market has rarely dropped more than 3%, with exceptions seen only in 2008 and a minor 3.05% decline in 1990. This is why, though seemingly insignificant, the 3.6% decline holds immense significance, signaling a fundamental change in the market dynamics. How so? Continue watching as we break it down for you. Experts suggest that if history is anything to go by, we are already in the crash. Currently, we are in the denial phase of the crash, where private sellers maintain inflated prices, perpetuating an illusionary market. With all that, it is essential to realize who the true movers of prices are. It's the builders, colossal corporations with vast resources and an acute understanding of supply and demand. In recent quarters, these builders have taken decisive actions, slashing prices and offering incentives to offload inventory. This shift in the new home market will inevitably impact the existing home market as buyers compare prices and weigh their options. Let's take a closer look at the previous housing crash and what history has taught us about market crashes like these to understand how and when they unfold. At the start of the new millennium, the prices kept going up, and the peak of prices was reached in July 2006, initiating a gradual decline that would span several years. However, it's important to note that this decline occurred at a sluggish pace. By July 2007, the CaseShiller Index had only dropped by 1.95%, giving us a perspective on the slow nature of the downturn. Just for comparison, in the past 5 months, we have seen a larger decline than what took place in an entire year during the previous crash. If that's not enough indication of what's to come, continue watching as we break it down further. Even 2 years later, in July 2008, prices had only fallen by 10%. The complete collapse of the market took 5 years and 7 months, bottoming out in February 2012 with a staggering 27.4% drop. Following the crash, it took an additional 5 years to return to the peak prices of 2006, resulting in a cycle that spanned 10 years and 6 months. This example underscores the fact that home values do not plummet overnight. Rather, it is a gradual process that originates with the builders and gradually permeates the entire market, purging the system of excessive greed. The journey is far from linear, filled with frustration, regret, greed, and numerous ups and downs. For generations, owning a home has been an integral part of the American dream. But today, that dream is in danger. Let's take a look at a simple graph to understand why. Using data from trusted sources like the U.S. Census Bureau, the Federal Reserve, and the U.S. Department of Housing, we created a graph to illustrate the affordability of housing since 1997. Here's how we did it. We took the median home sale price for each year, factored in the down payment, taxes, insurance, and interest rates, and calculated the monthly payment needed to buy an average home. We then compared this amount to the median household income, giving us a percentage that represents affordability. Over the past 25 years, this affordability percentage has mostly stayed around 39%. However, in the years leading up to 2008, it soared to as high as 46%, causing a collapse in prices and interest rates. Afterward, affordability improved, stabilizing around 35% for several years. But in 2020, something shocking occurred. The affordability percentage started climbing rapidly and didn't stop. By 2022, the average American homebuyer was spending over 52% of their income on their mortgage. We have now exceeded the relative prices of 2008. When we consider that 2008 was the worst real estate bubble this country has experienced, it begs the question, what makes this situation different and preventing a crash from happening? The simple conclusion is, it's only a matter of time. The current scenario is unsustainable when considering income levels, prices, and interest rates. One of these three factors must adjust. Looking at historical trends, it is unlikely that incomes will rise enough to catch up with the other variables, and interest rates are projected to remain elevated. According to statements from Jerome Powell, the Federal Reserve intends to continue raising rates throughout the year. Given this understanding, the only variable left to change is prices. Observing the affordability chart we discussed before, it becomes apparent why many experts are calling for a crash. Owning a home has simply become unaffordable. This is the case despite near-record low unemployment rates and significant income growth over the past 5 years. To summarize, without demand from ordinary Americans, it will become increasingly difficult for supply to remain low. Once the inventory situation begins to unfold, we will witness a decline in prices. This process typically takes years to unfold, but when we observe a turning point, as we did this past summer, it serves as an indication that we may be entering a long and painful bear market. This downward trend is likely to play out over the coming year, starting with the builders. When we review the earnings reports of some of the nation's largest residential home builders, the evidence becomes even clearer. Builders are slowing down, reducing prices and offering increased incentives. Since builders are the true movers of market prices, this action will gradually ripple down and impact the rest of the market. The similarities between the recent market conditions and those of the summer of 2006 suggest that the next 3 years may follow a similar trajectory. Remember that history has a way of repeating itself. The imminent 2023 housing crash is not just a tale of the past, it holds valuable lessons for our present and future. But don't let the story end here. There's so much more to explore, discover, and learn. So if you're hungry for more mind-blowing insights and an in-depth market analysis, we recently made a video on Tesla, which might indicate how its stock is going to play out in the long run. Click the video on screen now and set yourself on your path to financial success.